Bank of England has kept both its interest rates on hold at 0.5%. Now, Central Bank Governor Mark Carney has to strike a policy balance that will calm the markets as the pressure to raise rates continues to build. Richard Bestic reports from London.
It's the principle of unintended consequences which has come to haunt the Bank of England governor. Last August, Mark Carney debuted a central banking policy called forward guidance to help markets anticipate any rise in the bank's key interest rate. Carney pegged any rate hike to UK unemployment falling to 7%. This was supposed to reduce market uncertainty, but so far has had the opposite effect. With the British economy now accelerating, the jobless figures have fallen further and faster than anticipated, leaving the markets unsettled and guessing what the central bank will do about interest rates.
What can't go on forever at some point has to end. The only question is when. Mark Carney thinks it's going to be sometime back end of 2015 or maybe into 2016, but we shall have to see.
Britain's housing market's another concern. A housing shortage, low interest rates and overseas investors have pushed up prices so high there's talk of a bubble.
There are many ways to deal with a housing bubble should it materialise or should it threaten to materialise before we ever get to the state of having to raise interest rates.
However, the British Chancellor George Osborne admitted to a parliamentary committee only this week that house prices in Britain would probably continue to rise for another decade. So all eyes will now turn to next Wednesday's publication of the quarterly inflation figures, Carney's first opportunity to revise his forward guidance and perhaps once again soothe the markets. Richard Bestic, CCTV, London.